Hi, I'm Ruben Silver-Nigam from Property Solvers. For many long-term investors like us, building a property portfolio has never been about chasing trends. It comes down to understanding risk, managing exposure, and making decisions that still hold up when the market faces periods of volatility. In 2026, those fundamentals matter more than ever, not because opportunity has disappeared, it's the underlying dynamics that have changed, particularly around borrowing, tax, regulation, and how value is now assessed as those factors interact. So in this video, I want to talk about how building a portfolio actually works in today's environment, where the risks sit, and what successful investors are doing differently. Let's dive in. First off, the margin for error is much smaller than it used to be. Property investing in the UK still delivers results, but in many ways it's becoming far less forgiving. Higher interest rates, tighter lender stress tests, increased regulation, and rising operational costs mean portfolios now react much more sharply to pressure. A deal that looks fine on paper can unravel quickly if rates end up staying higher for longer, voids stretch, capital is tied up too aggressively, refurb costs overrun, or refinancing assumptions don't play out as expected. That's why portfolio building today isn't just about growth, it's about resilience and avoiding overexposure. Secondly, portfolio growth is about quality of scale, not speed for its own sake. Scaling a portfolio is increasingly necessary to remain competitive, particularly as larger operators and institutional landlords benefit from economies of scale, but only when it's supported by solid cash flow and sensible gearing. What's changed is not the value of repeating a working model, but the need to retest it each time you grow. In earlier market conditions, investors could often scale by rolling out the same approach, with confidence that borrowing, refinance, and cash flow would broadly hold up. As the market evolves, the margin for error continues to narrow, which means that every new acquisition needs to stack up on its own numbers under more conservative assumptions. The investors who are scaling successfully are doing so deliberately, making sure each new purchase improves the portfolio's net equity position and long-term resilience, prioritizing good, proven locations with consistent demand rather than stretching purely for yield, avoiding overconcentration in a single strategy or funding structure, and checking how the portfolio performs if conditions don't improve as quickly as expected. So scale deal matters, but it needs to be earned, supported, and sustainable. Third is that leverage still has a role, but it needs to be controlled. Cheap debt hid a lot of risk in the past, and today, leverage magnifies mistakes just as quickly as it magnifies returns. And it should support a good deal, not just rescue a weak one. Stronger portfolios in 2026 tend to share a few common characteristics: more conservative loan-to-value ratios, liquidity buffers to absorb periods of higher costs or slower progress, well-maintained assets that remain lettable and financeable as standards rise, a clear understanding of how each property fits within the wider portfolio, and the flexibility to adjust if funding, regulation, or market conditions change. Next, cash flow resilience matters more than portfolio size. Owning more properties doesn't automatically mean a stronger portfolio. For many years, large buy-to-let portfolios were built in an environment where mortgage interest was fully deductible against tax. The introduction of Section 24 fundamentally changed that equation, increasing tax pressure on personally held leveraged portfolios and materially altering post-tax cash flow. One clear response has been a rapidly growing shift towards limited company ownership, particularly for new acquisitions, as investors look to regain interest deductibility and manage tax more efficiently. But that shift also means cash flow, funding costs, and extraction planning now need to be thought through much more carefully. What matters now is how a portfolio behaves under stress, how sensitive it is to interest rate changes, how quickly voids or arrears create pressure, how much headroom exists once tax and compliance costs are fully factored in, how dependent returns are on refinancing assumptions holding up, how exposed the portfolio is to changes in lending criteria, and how easily issues in one property spill over into the wider portfolio. Refurbishment and maintenance costs are another area that can quietly undermine returns if they're not budgeted properly. Bill costs, materials, and of course contractor fees have all risen, and even modest overruns can absorb years of profits if they haven't been allowed for up front. If a portfolio only works in a best-case scenario, it's fragile. The strongest portfolios today are built to cope with delays, surprises, and imperfect conditions, because those are no longer exceptions, they're part of the normal market behavior. Next is the importance of understanding the impact of regulatory oversight. Regulation is no longer something that you can deal with later, it directly shapes returns. Higher EPC standards, tenant protections under the Renters' Rights Act, licensing, safety requirements, and lender criteria will all continue to affect acquisition costs, refurb budgets, and exit values. Smart investors are pricing compliance in before they buy, not reacting to it afterwards. That doesn't make property unattractive, but it does mean casual investing carries far more risk than it used to. Tax planning is one of the biggest dividing lines between strong and weak portfolios. In 2026, the difference often isn't headline yield, it's structure. For most leveraged purchases, buying for a limited company is no longer optional. Unless you're operating at very low loan-to-values or buying unencumbered, personal ownership quickly becomes tax inefficient once finance costs are taken into account. But company ownership on its own isn't the solution, it's just the starting point. What really matters is having the structure thought through properly, how rental profits are taxed within the company, how and when returns are withdrawn through salary, dividends, directors' loans, timing, etc., how chargeable gains are treated within the company on disposal, and how the portfolio fits within wider personal and business tax planning. This is where many investors come unstuck, building portfolios without a clear plan for extracting income, or copying structures without understanding the tax consequences. There's no universal best setup. What works for one investor can be completely different for another, depending on income, time horizon, funding structure, and exit strategy. That's why the quality of advice matters. A good property-focused accountant should be properly qualified, regulated, and experienced in working with landlords and property companies, not just general small businesses. In the UK, that typically means membership of recognised professional bodies like the ICAEW or ACCA for accountants, or the CIOT or ATT for tax specialists, alongside a clear understanding of property taxation, company structures, and HMRC expectations. Good tax planning won't turn a bad deal into a good one, but poor tax planning can quietly destroy an otherwise solid portfolio and potentially land you in trouble down the line. Next is to be careful who you take advice from. There's always something to learn, including from people selling courses, strategies, or other frameworks. But many of the approaches still being promoted today were developed in very different conditions: lower interest rates, lighter regulation, and more forgiving tax treatment. Education is certainly valuable, but it should inform your decisions, not replace independent analysis or due diligence. It's also worth remembering that you don't need to spend thousands of pounds on a course to build a solid understanding of property investing. There's now an abundance of high quality, free, and low cost information available through podcasts, long form YouTube content, and of course networking. These allow investors to educate themselves at their own pace. Ultimately, no advisor, course provider, or so-called guru carries the downside if things don't go to plan. Find people who are working on the ground and understand the realities. Next is building a clear acquisition strategy. In 2026, strong portfolios are built by finding the right properties, not simply more properties. That means focusing on assets where pricing reflects today's realities, where there's genuine seller motivation, and where the numbers still stack once borrowing, tax, and compliance are fully taken into account. Those opportunities don't come from one single route to market. They can appear through auctions, off-market conversations, direct-to-vendor approaches like what we do at Property Solvers, portfolio disposals, or a range of other situations. The common thread isn't how the deal is sourced, it's whether the margin is there. Buying well remains one of the most effective ways to protect a portfolio against higher interest rates, tighter lending criteria, and rising operational costs. And this is where access really matters. Investors who are connected to the right networks, deal flow, and investor lists often see opportunities long before they ever reach the open market. And that early visibility can make a material difference to outcomes. Next is planning properly for financing and expansion as your portfolio grows. As portfolios scale, complexity increases, not just financially, but operationally. Funding structures, refurbishment timelines, tenant management, compliance, and tax all start to interact. Decisions made in isolation can easily create pressure elsewhere in the portfolio, particularly where capital is stretched or timelines slip. The investors who perform best over time are rarely operating alone. They typically have clear visibility over deal flow and pipeline, access to experienced professionals, including lenders and brokers, and the ability to assess opportunities quickly against their wider portfolio objectives. Having a cash buffer also matters. Setting aside capital for unexpected costs, refurbishment overruns, or voids is often what allows a portfolio to keep moving forward when conditions tighten. This is also where strategies like buy, refurb, refinance, repeat can still work, but only when approached conservatively, with realistic valuations, sensible gearing, and adequate contingency. Bridging finance can support expansion, particularly for auctions, refurbishments, and time-sensitive purchases, but only where the refinance or exit route is clear and achievable, not assumed. As portfolios grow, building strong relationships with agents, lenders, brokers, sourcing partners, and investor networks like ours becomes increasingly important. So, to draw this video to a close, the strongest portfolios in 2026 and beyond are built to adapt. They're not designed for perfect conditions. They're built to hold up when things don't go exactly to plan. That means sensible assumptions, controlled gearing, flexibility around funding and holding periods, and reviewing performance rather than setting things on autopilot. This cycle will reward discipline and judgment, especially when they're combined with decisive action. So building a portfolio means treating it like a proper business. Buy well, manage risk, get the structure right, and stay adaptable as conditions change. If you're actively building or expanding a portfolio, I'd encourage you to complete our investor profiling form, which will help us find opportunities that fit within your specific criteria. The link is in the show notes. I really hope you found this video useful and would really appreciate it if you could give it a like and subscribe to the channel.